Welcome back. Stocks on track for another record close. Here to share where he sees the market heading next is Chris Toomey, Morgan Stanley Managing Director of Private Wealth Management. It's good to see you back.
Thanks for having me.
You say good news is already priced in. Really? Like, you think it's all in?
No, I mean, I think we've been positive on the market. So I think the variables that were driving performance for us were, earnings breadth, which is continuing to look good. Yeah. Operating leverage looks good. Mm-hmm. We're in a situation where comparables are starting to look good. The dollar's weaker, which actually helps U.S. earnings. Inflation is still high, which conversely actually helps earnings. So before the Fed actually met, we were actually positive on the market and kind of leaning into our bull case. I think what we're also seeing is that capital markets activity that we've been waiting for. Yeah. You saw IPOs, 150 IPOs. We're still protecting about 200 for the year. You're also seeing M&A activity pick up almost 40%. So the market's pretty good positioning-wise right now. I think with the Fed stepping in, that really kind of provides a little bit of a tailwind with regards to kind of moving forward.
Well, sure. So how can it all be priced in if the Fed is just cut once?
No, I think I'm not saying it's priced in. I think our concern is maybe you've moved a little bit too fast off of all of this good news. I think we're still not expecting kind of a 20% rate of return over the next 12 months. We're probably looking at a more reasonable about 10% rate of return year over year here.
Okay. According to my notes, you suggest that there's peaking AI spend.
Well, that would be our.
Did you submit that before the NVIDIA news came out?
When we gave you our notes, it said the bull case and the bear case. So the bull case is specifically the things that we're talking about, which is you've got about $7 trillion worth of cash sitting on the balance sheet. You're in a situation where buybacks are picking up. You're about a third higher than before. And what happens is when rates start going lower, you're in a situation where companies can also finance those buybacks by issuing cheaper debt. Credit spreads are actually at all-time lows. And that demand with regards for money markets and treasuries also starts going down when yields start going down. So we all think those are tailwinds. Now, with regards to our bear case, I think there is some concern with regards to the fact that there's some fatigue with regards to AI spend. You keep seeing some of these things going on. Adoption hasn't been great. So I think some of the things that we might be concerned with, market got ahead of itself with regards to Fed cuts. Market got ahead of itself with regards to kind of this AI move. If you look at kind of retail positioning, retail is aggressively going into that market.
But that's your bear case. I mean, do you believe in your bear case? I mean, I ask you that because, like, when you see Jensen Huang today announce a $100 billion investment into OpenAI and then say it's additive to whatever they've done to this point, and then you suggest that we haven't seen a lot of adoption, I think was how you termed it. What do you mean by that?
Well, we haven't necessarily seen the adoption generate positive returns from a revenue standpoint. I think people are all adjusting to AI and adding it, but we haven't necessarily seen those radical changes that we're expecting. We anticipate seeing more of that probably in 2026 and 2027. So maybe you pulled forward some of that return in this year that you would have gotten in 26, 27. I think the bigger issue for AI is you've got all this spend going on. The concern is, where is the energy that you need and the delivery of that energy in order to make this happen? It's great.
But that's why the power players, so to speak, are going up as well.
Absolutely.
Are you suggesting we're not going to have enough?
No, I think that's probably the next area of opportunity for investment. So
it's already up a lot.
So it is up, but I still think we need more. We need more data infrastructure. We need more infrastructure with regards to power. We need more efficiency with regards to how we use power. So one of the things that we're doing from a positioning standpoint, we've had a lot of outsized exposure to private credit. We're reducing some of that exposure, and we're adding to infrastructure because we see that as a critical component to the AI infrastructure.
Are you a believer in the broadening story in the stock market, or because of announcements like you got today on this network, just don't overcomplicate it? Just stay with this trend. It's so powerful. These are the places that are going to outperform. How would you answer that?
Yeah, I think you want to stay the course. So I agree with Tony P. I agree with Tepper. There's no reason to try and get cute here. You want to maintain that positioning. I do think that there's going to be a spreading out with regards to performance. We still like financials, which have done great. The big banks have done well. The investment banks have done well. We also like the alternative players, which are doing better. We also like industrials. We think There's a fair amount of CapEx that we need to continue to build out with regards to some of that tax benefit that's coming from the administration. That should also be helpful with regards to spend. So we think all of that should start to play out in other areas of the market.
All right, Chris Toomey, good to see you again.